Alright, real question for you. What's more impressive, beating the market once or beating it consistently over time? If you're aiming to measure skill and consistency, not just lucky spikes, there's one metric you need to know, the information ratio. And in this video I'll break it down so you can understand what the information ratio is, learn how to calculate it, and use it to evaluate fund managers, your own portfolio, or even your favorite trading YouTuber. The information ratio, or IR, is a risk-adjusted performance metric. It tells you how much extra return you're earning compared to a benchmark, and how consistent that outperformance is. In other words, the information ratio tells you how much alpha you generate per unit of risk you take versus the benchmark. It looks a little bit like the Sharpe Ratio's cousin, but instead of comparing the risk-free rate, we are comparing to a market benchmark like the S&P 500 or to the top 50 cryptocurrency pairs. Here's an example. Let's say that you beat the market last year. That's nice, but that was maybe a one-time fluke. Or are you consistently outperforming the index? That's what the information ratio answers. A high information ratio means that you're consistently adding value. A low or negative IR means that your results are all over the place or underwhelming. It is a great way to judge fund managers, robo-advisors, trading strategy YouTubers, or your own strategy's consistency over time. Here's the formula. The information ratio is your portfolio return minus the benchmark return divided by the tracking error. Let's break this formula down. The portfolio return is how much you have earned. The benchmark return is how much the market earned. And the tracking error is how volatile your outperformance is. It's basically the standard deviation of the difference between your returns and the benchmark returns over time. Let's bring back Bob and Alice again. They are both portfolio managers and their performance is measured against the same benchmark, the S&P 500, which returned 9% over the last year. Bob's return was 12% and his active return is 12% minus 9% equals 3%. Now let's say Bob's monthly active returns looked like this over the last year. We can now calculate the standard deviation of those values, and that's his tracking error. In total, this is around 4%. Now plug these numbers into the information ratio's formula, and we get a 0.75 information ratio. This is not terrible because he beat the benchmark, but his performance was pretty volatile and inconsistent. Let's do the same with Alice's portfolio. She also has a return of 12% minus the 9% benchmark of the S&P 500 equals also 3%. But if we now take the standard deviation of Alice's monthly active returns, we get a tracking error of around 1.5%. Let's put this also into the information ratio's formula, and this gives us an information ratio of 2.0. So this is an excellent number. She achieved the same outperformance as Bob, but with far less risk and volatility. Bob and Alice both beat the market by 3%, but Alice did it with much more consistency, and that's why her information ratio is better. In the end, if you are an investor, you want Alice managing your money, steady, smart and consistent. Here is a cheat sheet with information about how a good information ratio should look like. Below 0.5 is weak and inconsistent, between 1.5 and 1 is a moderate skill, between 1 and 2 is very good, and 2 and above is the elite fund manager territory. Consistency is key. Information ratio rewards smooth, steady outperformance, not just big wins followed by big losses. In the end, you'll find that the information ratio is used to compare mutual funds or ETFs, comparison of the backtest of your own trading strategy, or evaluating advisors or signal services. It is especially useful when comparing actively managed portfolios to passive index benchmarks. So, to do a recap, the information ratio is the active return divided by the tracking error. It tells you how consistent your outperformance is. And the higher the ratio, the more reliable your edge. So if this video makes sense and helped you learn something, or it gave you a new way to measure your portfolio, then click on the like button. If you like, you can drop a comment with your current IR if you know it. Now subscribe if you don't miss the next performance metric, and become a patron if you want to support me and motivate me to make more videos in the future. I have also written a book that contains more information about algorithmic trading, and it contains a whole chapter on how to analyze your results and determine the best trading strategy for you. If you want to know more about other investment ratios and how to use them, then check my playlist and watch out for future videos in this series. Thanks for watching, and I'll see you in the next video. Goodbye!